Happy birthday to you. Happy birthday to you. Happy birthday, dear Edge Finder. Happy birthday to you. Woo!
Right now, we've seen the stock market continue to bounce back, regardless of what I would say is a pretty sketchy yields market jump. So I'll show you, or the yield, right? The 10-year yield is on the rise. And I'll show you that this is not usually, at least in recent times, associated with a positive thing for stocks. If you're getting a rising yield on the 10-year bond or 10-year government note, if you're getting a rising yield, what that's telling you is that the bond market is saying that they think inflation is going to be problematic. They think that the US economy is strong, and we saw evidence of that with last Friday's jobs number being really strong. What that is pointing out for us is that the bond market thinks the economy is staying hot and inflation will stay sticky as well. Remember that if there's more economic activity, it typically keeps prices elevated because there's strong demand from consumers, from businesses, etc. So as we approach this CPI number, if this does in fact continue to beat expectations, or I guess improve, they're hotter than expected, right? Because beat is maybe not the right word if you're talking about the stock market. If you get 3.5%, for example, and inflation seems to have actually bottomed out, that's going to be very, very nerve-wracking for traders and investors who are watching things like stocks and gold, etc. So basically this week, if you get hot inflation, it'll probably strengthen the dollar, and with it will probably cause gold and the stock market to drop. If, however, it comes in cooler than expected, the opposite would be true. People would probably cheer and celebrate the idea that interest rates could actually come down because inflation is getting put under control. So that's why Wednesday's number is going to be so incredibly important to financial markets. Now, what does kind of scare me, what is a little bit nerve-wracking to me at least, is that you have the NASDAQ, you have the S&P 500, they're still trading near all-time record highs. At the same time, you've got gold, which refuses to stop going up. At the same time, you've got oil, which refuses to go down. Did you guys see oil overnight? Of course, I'm long oil, so I got very, very, very glad when I saw that this level of support that I marked out and put my stop loss below got held beautifully. Look at this. So it dropped in the early components or early opening up during the market this week and rounded off just shy of my stop loss and has rallied back. Oil is just on fire right now. Same with gold. Both of those commodities just refuse to quit. They just keep going up and up and up. And that will change at a point, but I would not hold your breath. That's been my perspective on the stock market as well. But gold and oil are now doing the same concept. I would not try and time the top of these moves. They just seem indestructible right now. And while that won't last forever, it is the prevailing story currently. Commodities are hot, and trying to sell them is a rough game. So again, I am still long oil and gold. Here are my current positions on it. They have just become really good trades for me. And I was early a few times. I didn't have, this wasn't like my first attempt to get long gold and oil, but it doesn't even matter, right? The cool thing about trading when you trail stops and you let winners run is that you can have a couple losses trying to get into a trade, but then if you catch the good one, that's all that matters. You just trim trail and let winners become huge. And that's what we've done on gold and oil. So these trades have become monster positions, and they weren't necessarily taken on massive amounts of risk, right? Anyways, gold also probably time to trail a stop. In fact, I'm gonna need to trail a stop yet again here on gold here today. So I'm gonna go ahead and mark up a fresh level of support. We're looking at the 4-hour chart. I entered this thing so far back now. I'll show you on the daily chart in just a moment. But first, I think I do need to trail a stop on this and just let's check on that one. So again, gold is up like just insane amounts here in the last couple months. Anyways, stop loss is going to get moved up here. So I'm going to put my stop loss just below. Again, if you guys were watching gold on the open, I don't know if you guys saw that, but oh my goodness, gold on the open wicks down here very quickly to this level support, and buyers immediately and violently bought the dip. So for me, this is a market I want to stay long. I love the price action. I love the fundamentals, but I've got to continue to trail stops and be prudent with my trade. So what I'm going to do right now is I'm going to trail my stop on GLD, which is where I've got the trade open. So stop loss is about 1.4% below current price. So let's do the same concept here, 1.4% below current price. It's going to put us at 212.72. Okay, I'm going to modify that trade. So stop is trailed on GLD and on XAU USD, where I track the spot price.
It's our Edge Finder anniversary sale. If you want 40% off the Edge Finder, the absolute best deal of the year, don't wait and head on over to a1trading.com to chat with one of our representatives live right now. This is the biggest discount of the year, and we have so many new features to share with you, like our smart money indicator that directly compares COT data and retail data against each other, or our brand new data scanners with even more useful information and accurate scoring than ever before. Now is the perfect time to get this powerful trading tool because the 40% discount won't last forever. Celebrate the Edge Finder anniversary by grabbing yourself a copy today on our website, a1trading.com.
Okay, so S&P 500 was the biggest net change, very impressive there. The Nikkei also, Swiss franc, pound, US oil, love to see this. Gold actually had slight selling going on from institutional money, not heavy. I wouldn't take this as a huge sell signal, just a slight sell. US 30 got sold, Euro got sold, Yen got sold, Dollar got sold. If anything, dollar getting sold is also kind of positive for gold. Pound, oil, I love to see this. We continue to see on the Edge Finder, oil has just been such a monster signal from the Edge Finder. We continue to see that. The commitment of traders data came out really positive, gave us a +3, which bumped our score to a +11, which makes me very happy to continue holding my oil long position. So let's go talk oil. Do I need to trail a stop on oil here this morning? Look at that, indices flipping red here on the day now. We'll check back on that in just a second. Oil is ripping. Again, I think that they're just, for me, if I'm looking at the indices, if I'm like heavily long indices right now, I'm concerned because you're seeing gold rip, you're seeing oil rip, you're seeing yields rip. All of those things are scary to equities traders. So I actually would not be surprised if we do see a down day on the S&P and the NASDAQ. But we'll see. Again, the NASDAQ, and they've defied greater odds before. So we'll just have to keep an eye on it. Anyways, US oil continues to rip. Let's take a quick look at, in terms of stop trailing, I don't need to do anymore. I've got my stop trailed. We wicked down here. I'd like to see this clear the highs. If that does happen, then beautiful, and we'll trail stops further on these trades. Euro dollar, nothing there. Pound dollar, nothing there. Dollar yen, kind of interesting. Dollar yen's trying to break and retest this area, though. For me, I'd probably like to see this clear a little stronger because I don't know that this is, really a clear breakout just yet. Depending on how you drew your resistance, right? You could just say we're sitting at resistance. So I'd like to see on dollar yen a breakout here. If you're watching currencies, that's probably one of the only ones that's really interesting to me right now. Other things that are interesting here, dollar yen's getting a really strong bullish lean here. If I take a look at, let's go by category really quick, major currency pairs. Dollar CAD bullish, dollar yen bullish, Kiwi dollar, pound dollar bearish. So just for the currency traders out there really quick, pound USD, I've mentioned this one. I'd be interested in pound dollar if it broke this daily structure. Otherwise, kind of just sidelined. Kiwi dollar, this might actually be interesting. Kiwi dollar might be interesting on the 4-hour chart. So if price does give you a pullback here, that might be something I'm looking at for a breakout retest. Dollar strength seems preferable. It's not necessarily that I think, oh, they're going to stay higher for longer forever. I still think they could because yields are up so much. The bond market thinks they will. But that being said, in comparison to the Kiwi dollar, right? All of our economic indicators, barring a few, are signaling mostly dollar strength. So it doesn't mean that I'm like a huge dollar bull, because we're not getting a resounding everything bullish for the dollar, but a lot of things are. And so I'm not going to ignore those signals. I would actually say, in terms of a lot of the major currencies, I would favor the dollar due to all the strong economic data we've been seeing relative to peers. And also, again, with yields up, as well as that jobs data that we saw on Friday, I actually think the dollar is likely to stay strong relative to its peers. I think if you're conservative with it, maybe you wait for something like this. Maybe you wait for a breakout of this high, and then you look to take advantage. But I would say if you look at the 4-hour chart, we've hit a level of support here, and we marked up last week. This level here, right? Resistance, support, came back, doubled as support again, very nicely. As long as this level holds, I think the dollar strength could still be there. If you break out to the downside, then yeah, it's kind of off the table. But I would say I would lean more dollar bullish than I would dollar bearish at this time. There goes the indices sliding here a little bit this morning. The NASDAQ just completely U-turned. That was kind of a crazy reversal here. Right, there's the 1-hour chart. It was shot up and then now coming back down. And another check on commodities. Gold just about flat on the day. Oil rebounding all the way from its depths in despair, came all the way back. Silver up 0.62%. Silver's been on a rip. I don't know if you guys have been keeping an eye on it. Silver has been way more impressive than gold even. It's up like 25% in the last like 30, 40 days, which is incredible. So very impressive. And we love to see that for metals bulls in general. That's what you want to see. You want to see silver exploding in price. You're even seeing platinum take advantage of it. What about copper? I'm just curious. Copper. Look at copper, man. Copper's going nuts as well. So you want to see, generally, for metals traders in general, you want to see participation across the board, similar to stocks, right? If you want to see a healthy stock market, usually you want to see participation from lots of different areas of the economy. You don't want to just see, a lot of bears have really pushed on the idea that, the stock market rally has only been participated by, big tech. And that's kind of changed. You've seen a lot of other areas coming to life for the stock market. And that's adding, in my opinion, some validity to the push. Doesn't mean we don't, need a pullback. I think we probably still should see a pullback. But it doesn't mean we have to have one, and participation is generally good. Same thing for metals. Here's the Dow bouncing slightly off of this level of support. We'll see if that can continue to be the case. And as we come back up to this area, are we going to resist this 39,200 and go lower? Or are we going to break that and kind of continue higher? That's where I'm curious here today on the Dow. Ivan, last week, jobs were really strong. We had a really impressive NFP. Wage growth came slightly down year over year, but overall, pretty hot jobs number. And meanwhile, the question is, this week we hear from a couple central banks. We have the meeting minutes on Wednesday. We get CPI this week. What are you looking out for this week? What's on the radar for you?
I think I am quite interested in not trading euro and Canadian this week because I am yen weakness this week. So I'm taking a very close look at dollar yen coming up to 152. But so my kind of preview is bearish CAD because of CPI, bearish euro, also ECB and Bank of Canada. Both of them are bearish because they're going to talk and they're going to acknowledge that they need to start cutting rates soon because they're both at 2. Euro is at 2.5 and Canada is 2.8 inflation, contrary to dollar, contrary to America. So yeah, that's kind of where I am.
Yeah, I think despite the jobs data being hot, with the jobs data being hot and hearing from the central bank, you mentioned Bank of Canada is on Wednesday. If they sound dovish, meanwhile, jobs data still is incredibly strong in the US. I generally agree with that because if you get inflation cooling for these places a lot faster, they're going to have to start cutting rates. And if the US, if you look at the yields world, it's signaling that the bond market doesn't think inflation is really seriously coming down anytime soon. You can see the 2-year yield is up, and the 10-year yield is at a multi-month high going back since November. So, again, the idea that inflation is just meaningfully going to continue to come down is not necessarily the same case right now. In fact, it makes me a little bit nervous for equities, Ivan, when it comes to inflation was meaningfully coming down. Expectations for rate cuts were very strong here. They've rebounded a little bit, and yet we still have Jerome Powell, the chair, still signaling 3 rate cuts this year. Who's right? Who's wrong? What do you think do you think we're still going to get 3 rate cuts this year?
I had a very interesting meeting this morning with the VIP group, and I opened up the question: Are we going to have a rate hike this year? Because currently there's a slight overchance, there's slight more probability for 2 rate cuts this year, and we might, as in the case of we see a rebound in inflation, which start supporting that idea, we might have a rate hike, and that is it's a long shot. It's an extreme one, but to have 3 rate cuts, I think that's off the table at the moment with the current PMIs coming out. I don't think we are close to rate cutting as much as we were in December. I'm just looking at the 10-year T-note. As much as I see the dollar, those are quite close in price action if you add them on top of each other just by looking at them. But yeah, I would argue that the 3 rate cuts until the next meeting, I think it was 1st of May, they're lagging because they have more data in between, so we have access to. But in the end, I think we may not cut this year. Which is a very scary thought.
Yeah, and if we don't see rate cuts this year, I would actually say that the market itself, like the stock market, probably would see a pretty good pullback. Because again, I would argue that the market is very much pumped up on the idea that rate cuts are coming. So if the yields world is signaling, 3 rate cuts is not coming, but the stock market is hoping for that, I don't know. Could that lead to what kind of pullback? Is that, you think, 5% pullback, 10% pullback? And obviously, as you mentioned, if you get rate hikes even coming into the conversation, that's probably a 15% plus pullback on the S&P 500. Would you agree?
In as much as I can agree, I think that the market is a bit... Well, we have put a lot of eggs in one basket. We're quite high. But there is less connection between rate hikes and stock market falling. So to me, it's more like it will probably just make it pause it for some while, and then we would reignite whenever. Because if we take in consideration what has 5% increase of interest rate done to the market, and it hasn't been considerably. As we're speaking, we are at all-time highs, as far as I remember.
Yep.
So it isn't nowhere near. So as a bad situation, we're gonna come crashing down. I don't think so. I think we're just gonna have about maybe a 5%, but that's
I think that, like, when it comes to the stock market, just being regardless of the pace of interest rate cuts, the idea that we are going to cut, as long as that continues to stay the narrative, the stock market's going to stay relatively supported. The only thing I would say that would completely wash that idea out the window, throw it out the window, would be if rate hikes became a concept again. But there are some things that are definitely worrisome to the idea of getting inflation down. For example, oil just does not want to quit. It keeps going up. And, between the 10-year up, the oil market up, these things are, signaling inflation. And not only that, you also have gold up, arguably not just because of rate cuts. Rate cuts might have been this move, but also geopolitical tension continues to push gold up. And with geopolitical tension, one thing to remember with geopolitics is that if they escalate, that too is inflationary. Because if things escalate in the Middle East or things escalate in Eastern Europe. Both of those scenarios probably end up being more money printing from Congress, and money printing, inflationary. So again, geopolitics, oil signaling, supply-based inflation could still be in the picture. And at the same time, the U.S. economy, jobs, really strong. To me, it's a time to be very cautious if you're looking at indices, because they've had such an incredible run. While I'm not short them and I'm not advocating for shorting them, I do think it's very much at the, I think most likely we either go sideways or we go down. But to me, I don't see right now us repeating this process into the future. Could it happen? Sure. The market's done crazier things than that before. But I think it's probably a time to step back and just say we've had an amazing run in stocks, and there's just a lot of forces that are at play here. Would you agree, Ivan?
I think most of your run at the moment is a bit of a perfect storm. We are ending rate hike. We're having an election year, so most of the money will be made now, or it'll be invested now, so they can be taken up, so they can have money before the election. Seasonality is strong at the moment, and well, there is available money, evidently so. So for me, I think it's just a perfect storm that this bullish run has had ever since start of October, which we called out. And on the other side, for me, global politics is kind of, it's becoming a bit more constant. It's a bit more solid and set. So it's just more like a slow burning thing that is there, instead of it being very forefront volatility driver. But yeah, I think it's a perfect storm for S&P going higher. Has been, may continue.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.